Packed with some opinion from the 21st Motilal Oswal annual Global Investor Conference. Our colleague Nimesh Shah did catch up with Nitin Jain, who's the CEO and Principal Fund Manager at Kotak Mahindra Asset Management. He manages over $5 billion in terms of funds. He shared his outlook on the Indian market post the recent correction and how to tackle the tariff uncertainty. Listen in.
The mood about Indian markets, honestly, and thanks Nilesh for having me, is a little bit, not the best of the moods at this point of time. That said, there are a lot of things which are working behind the channels. Of course, currently speaking, the tariff, the US tariff, is overwhelming everyone's opinion about India. Maybe this is a good time to reassess India. The pessimism seems to be at real peak as we speak.
Sure. So, are you looking to deploy more funds into India? How are you positioned in India right now? Are you sitting on cash? Are you fully deployed?
So, as a philosophy, we are a single country India fund.
Okay.
We don't tend to use cash as an instrument. Okay. So, what we do is always for long-term investing. So, we don't change our portfolios too much in that sense. So, in some ways, we are invested in India, and the current valuation and the pessimism that we see, there is no reason for us to
hold back.
Sure. So, but we will have some cash here and there, but it's not out of sync with our long-term trends.
Okay. Nitin, the very near-term trigger is going to be the GST rate rationalizations. That's something which everybody's been talking about. As a fund manager, have you looked at realigning your portfolio to some extent towards consumers? Because that's been the big talking point that maybe it's time to shift from capex to consumption.
If you look at that theme, last few years it has been more about capex, infrastructure. But we have been very, very clear in a long-term view that in India, consumption plays a very important role. As incomes rise, consumer discretionary consumption will take a big benefit out of the income rise. So if you look at our portfolios, say 6 months back, we were overweight consumers, especially consumer discretionary. Now the new environment makes that view even positive.
Sure.
So we have seen tax cuts, we have seen monetary policy rate cuts.
Right.
We're now talking about GST rationalization. We are running into festive season. We have seen low inflation. We are talking about rural income recovery. So consumption, broadly speaking, remains a core of our portfolio. Now all of these steps are going to be taken positive from our perspective, just reinforces our view that consumption should be a core of your portfolio at all points of time.
Sure. Just to play devil's advocate on consumption, Nitin, there is an argument that the valuations are still not very cheap for the consumption stocks. Everybody's sitting at 40, 50, 60 times. But you sitting out of Singapore, looking at all the other markets as well. In that context, do you think Indian valuations of Indian consumer names are decent enough?
So,
how do you look at consumption as a basket?
So consumption is not at the same valuation that the market is. When you think about India premium to emerging markets, it's come down from a very significant premium towards long-term averages, which is still a steep premium to other emerging markets. And there are many reasons which have been documented over a long period of time why India enjoys a premium. In our view, nothing dramatically changes in that. The reason for India premium stays, and the premium has now come down to long-term averages. Now, within a micro sector of consumers, India consumer story is very, very, very promising. Ultimately, it's 1.4 billion people who have a combined story of penetration, premiumization, and consumer discretionary on top of it. So I think the story on long-term basis is very, very intact as we speak. Now, valuation, one may look at growth. So consumer staples may look expensive, consumer discretionary may look expensive, but our view in consumer discretionary is consumer discretionary has much higher level of growth and profitability levers, than what the other segments of consumption may have. So we are looking at businesses where there is obviously growth and there is profitability to follow.
Apart from consumption, how are you positioned in the Indian markets in terms of IT, in terms of say metals or any sector which looks very attractive to you at this point in time?
So traditionally, we are not a very large commodity investors. So we tend to stay away from energy commodity in our portfolios. So we are in IT in specific a little bit cautious, given how things are panning out. I think at this point of time, the valuations are looking reasonable. We do worry at some level that the US-India tariff situation does not extend to services. Hopefully it never does. So that's a risk that is there, but that's something that we really don't overtly worry about it, but it's back of our mind. But net to net, we are positioned well in consumption, we are positioned well in financials, we are positioned well in healthcare. We look at services in a positive view, and we have others, like we have toned down or dialed down some exposure to industrials in favor of consumption. That happened over the last 12 months. But broadly speaking, that's where we are well positioned in our portfolio.
Sure. Nitin, I know you're known as a champion for mid-cap picking. You're broadly into the mid-caps and small-cap universe. What's your take there? Broadly, from a valuation point of view or from stock picking point of view, are you finding enough opportunities in the broader market stocks?
So first, let me correct, we are in mid-market. Yeah. So we do run all cap and we have mid-market. So we have a large mid-market practice at our end. Yeah. So our focus is not on the smaller mid-caps, we focus on the larger mid-caps, which are category leaders, good strong balance sheet, good management. So we stick to that. Interestingly, our mid-market universe over the last 5-6 years has widened quite a bit. Yeah. So we have more and more opportunities. Yes. Of course, we know that liquidity has also improved quite dramatically. So the risk associated with mid-caps, traditional risk of illiquidity or diversification is no longer a problem. In the last 4 or 5 years, the balance sheets of mid-market companies have also improved quite materially. So we are not finding any big need or trouble on the other side of finding good businesses. Now our businesses are growing at a clip which is faster than economy. We know that economy is going through a little bit of volatility at this point of time, but as long as the underlying businesses that we own are doing what they are expected to do, we are not too overtly worried. But we keep a very close eye on the macro developments, and in that sense, obviously the US tariff situation is something that one keeps a close view on.
Okay, interesting chat there with Nitin Jain, but let's talk about some of the